Morning Club. Really happy to have you on the call today as we discuss M&A trends. Obviously, there's a lot of churn taking place in the industry and consolidation as master limited partnerships, publicly traded companies, private equity companies, and even just regional traditional players are working to consolidate the market. So it'd be real nice to hear from both Tom Kelso, who's the managing director and principal for Matrix Capital Markets Groups, and Greg Couchard, who's vice president of Lockton Insurance Brokers, are going to discuss key trends that are taking place from the M&A perspective in the market today. And Greg is also going to share some about the due diligence process, because many of us out here are looking to be the acquirer and not necessarily the seller in today's market. And Greg will provide some nice tips and tricks for us to keep in mind as we're out trying to make deals work. And Tom Kelso, are you available to hop on the line?
I am in.
All right, Tom.
Plans worked.
Great, Tom. I'm going to hand controls over to you and allow you to jump in. And for the audience, just informationally, I've got everybody unmuted. That way we don't pick up background noise and so forth. But if you have a question, please type it into the dialog box that's in the Go to the Webinar framework. I can read those questions and I will relay them to the speakers at an appropriate time. And we'll work as best as we can to answer everybody's questions, and it should be an informative next hour. So Tom, I'll kind of turn the controls over to you. It looks like I can see your screen on my screen, so I think everything's working as it should. Allow you to jump on in. Thanks, Tom, for doing this.
Hey, great, Jed. Thank you so much, and thanks to everybody for being on the call today. I'd like to talk to you today about the factors that are influencing the consolidation in the convenience and gas market, and essentially give everyone an update on the CNG market itself. And so, I'd like to start off, by outlining the topics that we will cover. We'll talk about the actual factors that are driving so much consolidation today. We'll talk about, who the companies are that are really driving that consolidation from the buyer side. We'll drill down into some of the trends that are contributing to the factors driving consolidation. Some of them are specific industry trends, and some of them are macroeconomic trends that affect motor fuels consumption. And then we'll get into talking about public multiple comps for retail and wholesale fuels distribution companies. And then we'll do the same for propane and refined fuels distribution companies. Before I go forward, I do need to give you a little bit of a disclaimer. The Matrix is a FINRA licensed broker-dealer, and that nothing contained in this presentation is an offer or to sell or a recommendation to purchase any of the securities that we discuss. As a FINRA licensed broker-dealer, we maintain a restricted stock list at Matrix, and all of the companies that we would discuss today are companies that are on our restricted stock list, and neither our employees nor related persons can trade in them.
Thanks
so
for that
what are the factors? And so what are the factors that are driving consolidation in the CNG market? When we look at these, we basically break them down into two different subsets. The first is ones that we call factors that are likely permanent, and the second are factors that we think are subject to change. The first factor that is likely permanent is that the convenience and gas industry is for all intents and purposes, a mature industry where primarily on the motor fuel side in the most parts of the country is that the only new volume that people can acquire is volume that they acquire through either taking that business at street level or through some type of an acquisition. There are a few parts of the countries where actual motor fuel volume continues to grow, and in those areas, you can grow without having to take somebody else's. But for the vast majority of parts of the country and participants in the industry, the only real growth on the fuel side is by taking or buying somebody else's. To a certain degree, we might argue, and I'll get into some slides in a minute, that we might reflect on the fact that we might actually have reached a maturity stage in the convenience portion of the industry as well. And in a mature industry, it is marked by very slow growth or no growth, and marked by rapid amounts of consolidation. The second factor that we think is likely permanent is that the continued expansion by the highly recognized C-store chains is putting enormous pressure on companies. And the chains that I'm talking about are the Wawas, the Sheetz, the Quick Trips with a Q, Quick Trip with a K, and others that are expanding well beyond their initial footprint into geographies where they've not been traditionally before. And people who are not used to competing with companies like that are finding it difficult to do so, and it makes it a nervous time for people who don't have this highly recognized competition, but who know that it might come to their area. Another one that we just saw earlier this week is where Buc-ee's is going into North Florida, which will dramatically change some of the dynamics in that market overnight. Another factor that we think is likely permanent is that expenses are increasing faster than gross profits. I'm sure many of you have seen a presentation by Hank Armour at NACS, where he actually shows that according to the NACS data, is that expenses are increasing faster, and what's driving that are employee costs, minimum wage issues, potentially issues related to store manager salary increases, and then other employee-related costs such as insurance, et cetera. The next factor
Tom, I was just going to chime in. For our study groups, we've seen over a 10% increase in employee payroll, and one of the measures that a lot of our firms looked at is sales to labor dollar, and that ratio has been trending downward in recent years, which to your point exactly, the payroll costs are moving up faster than sales or gross profit.
Yep. And then the next factor is the continuing need to reduce product acquisition costs and to spread overhead over a wider base. And if you talk to the companies that are doing a lot of the consolidation, is that what they're looking for is not just new business, but they're looking to be able to reduce their product acquisition costs by bringing in additional motor fuels volume and additional C-store volume that gives them the ability to be able to negotiate with their suppliers to reduce overall product costs. And then, the other thing is that they talk about is that the synergies that they're able to get in terms of, being able to spread their overhead costs over a wider base. And oftentimes is that you might see a consolidating company, have an overhead on a per store basis that may break out to $20,000 to $35,000 per store, where if you look at a lot of the jobber type companies, privately held companies that we see a lot of, is that you may have overheads that are $50,000, $60,000, $70,000 per store. And so the whole goal is to make businesses more efficient through acquisition, reducing product costs, and spreading overheads over a wider base. You know, the next item that we think is permanent is that once you've got more and more public companies in the market, they're going to be under the same pressure that other public companies have, which is just to grow revenues and to grow cash flow. And in a business, a commodity-related business like the motor fuel business, where the retail price of gasoline goes up and down, you know, that puts a lot of pressure on these public companies to show a consistent pattern of growth. And the best way for them to do that is to continue to acquire, because even if they get caught in a down motor fuel market, price market, is that they can still, you know, make the case that they are growing units, that they are growing C-store sales, and that they are a growth story rather than a and they're starting to look at what's the next step for my company. Does it make sense to transfer this to the next generation? Or are we better off taking advantage of a market like this and liquidating, monetizing our assets and securing the long-term future of our family? You know, if we look at the industry, it's really more than just anecdotal. Is that for whatever reason, there are a lot of CEOs and primary shareholders that have reached that mid to late 50s age or older, and it seems to have happened, you know, basically all at one time. And as people are looking at this, you know, they're also looking at tax efficiency. And while, you know, we all have, I think, some hope that we might see some reductions in federal and state tax rates, especially federal rates, with Donald Trump as president, you know, there's no assurance of this. And I think that the fear that people have that federal and state tax rates are likely to increase over time is greater than the optimism that they have that we may get a temporary decrease. And then the last item that we think, yeah, go ahead.
I was just going to chime in on the generational issues. That as we sit around in our study group meetings around the table, kind of qualitatively, a story that's common is, well, you know, Grandpa started the business maybe in the 40s or 50s, and maybe worked for an oil company before and got a truck, and well, then, you know, my dad and his brother got involved in the business, and well, they all had kids, and now it's, you know, me, my sister, my three cousins that are in, but only one of us is active in the business, and we got 4 or 5 other shareholders, and it just complicates things. And then you see some divestments happening, you know, just from these generational aspects. When it was only Grandpa in the business, it was a lot easier than when now all of a sudden you have all these shareholders.
Yeah, there's no question about it, Jed. And, you know, we definitely see that as one of the primary motivators for people to exit the business. But we also see a fair number of people who are saying, what are my options? You know, are there ways to bring in outside capital to be able to maybe buy out some of the shareholders who are not otherwise active in the business? And, you know, so we see more companies forming boards, you know, some advisory, but some real boards, and some, you know, bringing in consultants, you know, to actually look at how to deal with generational issues that, you know, are on top of, you know, how do I acquire the capital to fund my buyout plan. And then the last thing that we see that, you know, we think is not only permanent, but likely to get even more exacerbated, and that is the cost of capital differences between smaller and larger operators. And so even though somebody is smaller, determined to grow their business, it's much more difficult for them to acquire capital at an all-in cost of capital that makes it so that with some of these large investments that people need to make in next generation convenience stores, that it makes it more risky for them. And so instead of being able to do what they would prefer to do, which is just to grow the business, is that the cost of new to industry, in many cases for smaller operators, is becoming prohibitive, partly because of these cost of capital differences, and where the larger companies, can build some of these new stores. And then if we look over at the things that we think are factors that are subject to change, we've got the fact that we've had historically low interest rates for a prolonged period of time. And, I think we all realize, and we've probably all been saying for a number of years now, is that, well, this is going to change. Our feeling is that at this point in time, is that we don't see any potential change on the horizon for 2017, or even maybe the first quarter of 2018, that would significantly change valuations versus the way that we view them now. Beyond the first quarter of 2018, I think we still have some concerns that interest rates might rise to a point where the net effect of that is it's going to lower valuations. And once it starts to lower valuations, then the idea of selling a business probably becomes, at least temporarily, less attractive. And so, interest rates are going to change at some point. That's probably going to reduce some of the consolidation in the industry, as even though buyers still want to buy, they're not going to be able to pay as high a prices as they have over the last 3 or 4 years. Another factor that, is somewhat related that we think is also subject to change, and that is that even though private equity funds have not had a tremendous amount of success at buying into the industry, is that they've had some success. And what we see is that there are somewhere between 5 and 10 private equity funds that have done a tremendous amount of work and have actually participated in sale processes for companies that we've sold or for companies that other people have sold. And while they may not have been successful yet, they continue to learn about valuation drivers and what it's going to take to be successful. And so, this additional competition, does help drive the price up of existing companies, which again makes it more attractive for sellers to enter the market. Once that private equity interest begins to wane, because returns are harder to achieve, what we'll end up seeing is, less competition coming into the industry, or at least potential competition coming into the industry from that sector, again, pressing down prices. And today, because of low cost of debt, because the banks are all very healthy and trying to find ways to make money, because we've got private equity funds that are actively looking for opportunities in the industry, and because we've got people who are providers of capital across the entire stack, there's a tremendous availability of capital today. So, even for larger privately held businesses that want to do an acquisition, that capital is available out there. Will it be available long term? I think that the history of this industry argues that it won't be, that it's available today. But as opportunities appear in other industries, the interest in this industry will wane and money will chase other opportunities. Another key factor that's subject to change is the future of the future performance of the few existing MLPs that are actually still public in the industry, and whether or not companies that want to become public through the MLP window are actually successful. And so whether or not these companies can be successful and not just successfully survive, but they need to be able to grow in order to survive. And they also need to be able to get their founders, the people who started these, there has to be enough trading volume in those MLPs in order to be able to get liquidity for the founders to exit through an MLP. So, that future performance is something that we've got to watch. I think it still remains very untested at this point in time. And, going along with that then is the ability for future companies to get public through the MLP window, and can a seller really take advantage of some valuation arbitrage between what the public markets will pay them versus what they could get selling their company privately.
So Tom, if I hear you
yeah,
right,
go ahead, Jed.
If I hear you right, your sense is valuations are going to continue to stay at the level that they're presently at, which on a historical basis is pretty high for at least the next year or so.
Yeah, I think that through the next 12 months, we're probably okay. And, as some of the people on this call probably realize is that, when somebody comes to us and says, I'm thinking about selling my business, the first thing that we're doing is doing a valuation exercise for that company, so that, before somebody moves forward into the market to sell their business, it's really important that they know what it's really worth before they do that, because of the risks inherent in taking a business to market. So, we're setting expectations today for transactions that probably won't take place for 7, 8, 9 months. And so, we have, a concern, a selfish concern, if you will, is that, we're worried that the expectations that we're setting with people today, are they available by the time that company would actually be able to run through a transaction process and then close. So, that's why we pay so much, one of the reasons we pay so much attention to it. And so we're pretty comfortable that what we're telling people today is probably still good for the next 12 months.
Makes sense.
And then, who are the companies that are really driving consolidation? And, everybody on the call knows is that this has changed dramatically even over the last 9 months or 6 months. But today you still have public companies that all want to grow their businesses to one degree or another. Some of them are, specific asset type or specific geography focused companies. But all of these companies here, to one degree or another, want to grow, and depending on who the target company is, would appear on a buyer's list. Same thing with MLPs. But today, the MLPs are different than if we'd have looked at this list, 12 or 18 months ago. Susser's MLP is no longer here, and Susser as a public company is no longer here. Today, Sunoco, they're probably only looking to grow in the future as a wholesale business or a dealer business, where 6 months ago, 3 months ago, we would have considered them also as a potential acquirer for convenience assets. Global is back in the market, and Cross America, well, it remains to be seen what will happen with Cross America once Circle K Couche-Tard gets the CST deal closed. It may be that Cross America goes away. It may be that it remains a separate company that owns some Circle K assets and supplies fuel to Circle K. That remains to be seen. And then on the private company side, 7-Eleven, while a quasi-public company in Japan, is a privately held business in the United States. We consider them private. You've got Empire and GPM that have both historically in the past filed S1s to try to go public as MLPs. They're all still acquisitive. Petroleum Marketing Group that's very strong in the Mid-Atlantic and the Northeast. And then you've got other companies by region. You've got companies like First Coast in the Southeast. You've got Norea in the Northeast. And then you've got United and Pacific and SC Fuels in the West Coast. And you've got Jackson's Food that's West and Upper Midwest. So, and there are other companies by region that would fall into that category. And so if we were to put a buyer's list together for a client opportunity, you know, some subset of all of these companies would probably populate that list depending on geography and asset mix. And then on top of that, we would add private equity funds. And while, you know, Copec is a Chilean company, and we would have considered it an international company just 6 months ago, you know, today we really consider it as a quasi-American public company because of the MAPCO retail in there. But there are additional international companies that are looking for dollar-denominated assets in the continental U.S. and could be factors in M&A deals going forward. So the long and short of it is that even though this list is constantly changing, is that there is still a substantial number of companies that have the desire, expressed intent, and the capital access to continue to grow. In addition to this, we would also put other companies on. Sure, go ahead, Jed.
Yeah, what do you see as the future of the MLPs? 3 to 4 years ago, I know there was a lot of trepidation that, hey, this industry is all going to roll up and be one subset of MLP. And where do you see this going with in terms of their involvement?
Well, I still think that we will see new MLPs. I think that Empire at some point will get public. I think, you know, GPM, if they still desire to go public, will do so. You know, these are reasonably strong companies that, you know, will have the ability to actually become public at some point in time. You know, I think that there are so many different factors that affect MLPs that you have to break it down, first of all, between sponsored MLPs and non-sponsored MLPs. So today, Cross America is a sponsored MLP because its managing general partner is CST. And a lot of the growth that Cross America experienced over the last 12 or 18 months was really drop downs that came from their sponsor company. So to the public, to the unit buying public, the limited partner unit buying public, you know, Cross America was still a growth story. You know, Global is, as an example, a non-sponsored MLP. And so the only business that Global has is in Global itself. And so all of the growth in Global is actually acquisitions of non-affiliated companies that Global goes out and buys. And so, you know, there is a different challenge there. And then Sunoco, you know, is actually, you know, maybe a hybrid, where for a long time it was essentially owned by another MLP called Energy Transfer Partners. But as Energy Transfer Partners needed liquidity, what they did is that they dropped a lot of the Susser and Sunoco assets into the MLP and took and leveraged Sunoco up so that they could give cash to their sponsor, which essentially over-leveraged Sunoco, which meant that Sunoco had to sell off their retail assets. So, you know, is a sponsored MLP an advantage? Is it a disadvantage? You know, and over the last 3 years since this phenomenon has come out, you know, we've been involved in discussions where people could argue both sides of this. And I still think it's untested. And when I get to a slide in a few minutes, Jed, I'll touch base on the relative size of these MLPs and just how small a public company they really are. And by extension, how fragile they are to economic shifts that, might not hurt a larger public company, but could damage a smaller private company. So, what are some of these trends that, drilling down, that, are really, creating some issues? Well, or some potential issues, or at least perception issues. Well, we don't have the 2016 data available to us yet. As soon as we do, we'll put it in. But, you can see, everyone can see, is that, industry, C&G industry profitability jumped up tremendously by $3.3 billion from 23 to 2014. And then basically it stayed relatively steady for 2016 or 2015. And so what is that? Well, essentially what that is fuel gross profits. And so, if fuel's gross profits from 2013 to 2014, jumped up by $5.3 billion, or a change of about 20%, while inside store gross profits were only up by about 3.4%. And so, what is driving that? And is that something that's really a paradigm shift in the industry, or is that something that is, ultimately going to be a headwind? And so I'm going to slide back a slide here. And here on this slide is as to what we have graphed is in the red line is crude oil prices, Brent crude on a spot price, and that's the left axis. And then the national retail gasoline margin cents per gallon provided by OPIS is the blue line. And we can see is that while there were periods of good motor fuel margins historically, is that there are more of those as the price of crude oil has come down. And so that where you could see is that margins were trending well below 20 cents for a large period of time in the period before that, is that you see now is that you find as many times where they actually go above 20 to 30 cents in that period since then. And so, is that a paradigm shift? Is it not? But I will tell you that from a valuation perspective, is that what has happened over this last 3 years has effectively worked its way into valuations for private companies, because what we traditionally show buyers and what buyers look for is 3 years of history. And so today what we're showing them is 2014, 2015, and 2016. And so the effect of higher margins is essentially fully baked into company performance and company valuation, and also the perception that companies have of what would a normalized motor fuel margin look like going forward as they project, an acquisition as it becomes part of their company. So, this is a very unique time. And so if this trend were to change, because motor fuel margins were to contract for some extended period of time, even if all other factors stayed the same, is that valuations would start to come down because lower, what we call normalized motor fuel margin margins on a normalized perception basis going forward would be lower than the way people are looking at them now as buyers. And so, is this a paradigm shift? If it is, then these valuations will, that factor at least will stay constant as part of valuation. If it's not, and we see some compressed margin year or two, is that we're going to see valuations, all other factors remaining the same, we're going to see those valuations come down.
It's interesting, Tom, because we have good study group data, and one of the metrics we look at is return on capital employed. So your debt and your equity that you've stuck in your business, what kind of return are you getting on that in total? And for the last 3 years, if you stick 2016 in there, the average return for our study group members is 15% return on their capital investment. And then we said, well, you know, let's look at C-store heavy guys. Well, they were right at 15%. Let's look at wholesale heavy guys, so dealer models and so forth. They were right at 15%. And then let's look at lube guys. They actually did the best. They were just about 17% return on capital over a 3-year period. So pretty impressive.
It is pretty impressive. And I think, you know, my question would be is that if you looked at 12, 13, 14, or you looked at 13, 14, 15, you know, would that trend show that returns are improving as motor fuels margins have improved? And then, you know, would returns, you know, diminish if that component of return that is motor fuel margin related, as margins go down, would returns go down? So, you know, I think this is something that probably a chart that everybody in the industry has probably seen. I'm not sure everybody's seen it graphed this way, but, you know, CAFE standards, we all know the effect of vehicle efficiency on motor fuels demand. And so what we did is that we went back though, and we looked at what was the compound annual growth rate of the CAFE standards between 2005 and the period that ended December 31, 2015. And for new cars, which is the blue line, is that compound annual growth, that change in the annual standard is really basically a compound annual growth rate of about 1.67% over that entire 10-year period of time. And for light trucks, it was about 2.35%. So looking going forward, this is what is in law and in regulation now. And so going forward is that the compound annual growth rate in vehicle efficiency for new cars would be 4.2%, or well more than double what it was in the previous 10 years. And while it's not double for light trucks, it still is at least a 50% increase. And so this is going to have a tremendous impact if it stays this way. It's going to have a tremendous impact on motor fuel demand going forward. Just because even though we've got fleets that lag, you know, the age of fleets lags the new car standards, is that, you know, eventually this will begin to catch up. Now, if the Trump administration is successful in reducing some of those, you know, it still will reduce them, but it'll probably still be more aggressive than it was in the previous 10 years. And this is something that, and I know a lot of you are NACS members, and the Fuels Institute does some great work. And this is something that John Eichelberger really turned me on to a 3 years ago, and we started to look at. And this is the change in driving practices in the United States. And as you can see, is that from 1970 on, except for some very brief periods of time, is that the vehicle miles traveled per driver on a population adjusted basis has continued to grow and grow very quickly. But you can see is that over the last 10 years, is that the trend is basically reversed. And while there's some bounce here, is that, you know, the question is whether that's a temporary bounce or not. And so what's driving this? And, you know, according to people who look at this research, is that it's people who are getting their driver's licenses at a later age, and it's people moving back into urban areas and either not owning a car and using shared vehicles and driving less, or whether it's, you know, people who are willing to carpool and really changing the way people drive. And the people who research this believe that it is most pronounced in people who we think of as millennials. You know, will they change their driving habits as they get older? You know, it'll be interesting to see. And so, you know, this is Energy Information Administration, the latest table showing projected motor fuels consumption going forward. And even though we've seen some bump here over the last couple of years. It's really bumped up a little, been flat, and then, because of the factors that I've identified on the previous charts, is that we'll start to see decline at an annual rate of about 1.2%.
So this is really feeding into your mature industry that you were talking about, Tom, and reasons for the consolidation taking place.
Absolutely. And, I know everybody here, is probably the most financially astute companies in the industry. And I know you guys look at your own financials and you do modeling. But, one of the interesting things is that we look at when we're modeling for somebody is that, we start to take a look at what happens if volumes were to decline out there, even if it's 1% to 2% per year. What does that mean over a 5-year period of time in terms of loss of value of the business? So, if you don't have the unit to sell to earn the gross profit, do gross profit dollars actually go down, or do margins go up to compensate for some of this? That's an unknown. But I think it's worth modeling out, especially as you look at future value of a business, to see is that even if you do great things by holding it, are there trends that you can't overcome, especially on a risk-adjusted basis, because in order to grow the business, you have to invest capital. Are you actually improving the value of the business, or are you just basically reinvesting capital to try to hold it steady by holding on to volume through more units?
So, Tom, some of our study group members, I mean, most of them are looking to acquire. And going back to your last chart, I mean, they see that picture of declining fuel volumes in the years ahead, and then they say, well, I don't want to spend that much to make an acquisition on something that may have fewer gallons in the future than it has today. But they look around at the landscape of what some of these larger companies are paying, and they're looking at the same chart too, and are just having trouble rationalizing it. Any thoughts there?
Well, I have some. I mean, look, is that, for every bear, hopefully there's a bull or more than one bull. And, what we're looking at here is that this is on a national basis, right? So, not every company is as affected totally by national trends, because there may be population factors that go on a localized area that, way overcome the reductions that are brought on by CAFE standards or by changes in driving patterns. The other is that, we're going to start to see a trend that we have started to see, and I know we've talked about this for 20 or more years, and that is that we're going to start to see weaker units go out of the chain. And I think we've all seen an acceleration of that over the last 4 or 5 years. And this, I think, maybe bodes well for people who are committed to growing with higher volume, better quality units that maybe aren't as susceptible to, that will be survivors as units in the surrounding market area maybe go away. And so, it may be fewer units supplying a reduced volume, but those units may be way more productive than the average unit would be today. So I think that for growth companies, there's a real opportunity here because it's going to pressure units out of the system. And I know, for example, on the CRIN upgrades to do the credit cards upgrades today, is that, distributors who are supplying units that were 250 or 300 or 350,000 gallons probably aren't going to make that investment, which is probably going to accelerate those units going away. And so I think that these trends, may actually help growth companies. And I think this is why some of our the really growing, well-known C-store chains are really expanding rapidly to help in their market areas accelerate the decline in units. So I think there's a positive story to it for growth companies.
Hmm.
And Jed, I really think is that, I know we're running a little out of time, and so, I won't go through all of the math here. But, what we're focused on is, how do you take public company data and use that public company data to track at least trends that are meaningful across private companies as well. And so what we did is we created what we call the matrix enterprise value corporate EBITDA trading multiple chart. And what we're doing here is we're tracking what is the median multiple on an enterprise value basis that these public companies are trading at, which is different than other stock valuation metrics. So what we're looking at is that we're looking at valuing each company on essentially what is its assets trading for in the market, okay? Because enterprise value is essentially equal to the value of all of the assets of the company. And so because private companies trade on asset basis, we can track this for public companies. And you can see is that at the end of the first quarter of 2010, is that these companies were trading at about 7.1 times. And today, if you go out here on the far right end of the spectrum, is that we're starting to see that, in the 10.5 times. And so if you look at the trend line, you can see is that there was a tremendous acceleration in valuation. And then for some period of time here, we've just basically been skating across the top, which is, plus or minus a little bit higher than 10, maybe a little bit lower than 10. And this is corporate EBITDA multiple. So if we were looking at this on an asset EBITDA multiple basis for public companies, it would probably be 1.5 to 2 multiples lower. And we can't compute their asset level EBITDA multiples because they don't disclose that data. So we can do it though on a corporate basis and then extrapolate it to what that would look like on a private company level basis. And so today, the public companies where unit holders and shareholders have total liquidity, and where the MLPs are making huge distributions over and above the 10-year treasury, is that they're trading on a corporate level EBITDA basis about 10.5 times, on an asset EBITDA basis maybe 8.5 to 9 times. And so, private companies would be on average, somewhat below that depending on asset mix. But, this is a good indicator that where we are is that we really have hit a peak, and we've been at that peak pretty much since the end of 2012. And so, we're not dropping down, but other than this brief period of time in the third quarter of 2016, which was really affected by merger activity, we really are at a point where we think we've reached the zenith, and that probably the only place to go would be back down. We do have it here, and we're happy to circulate it around. Jed, let me point out is that, here is that this stuff is available on our website. We update this every single quarter so people can actually see the math and understand how the enterprise value multiples are calculated, and we track all of these companies. So I didn't mean to interrupt, but go ahead.
Yeah. Well, I think this was great information, Tom, and I know we've got to move on to Greg so he can talk a little bit too. But I just want to let people know that we'll make these slides available after the call as well. Are you okay with that? I should say, Tom.
Absolutely, and we want people to have this information, so that would be great.
Yeah. So the big picture trend I see, just to recap a little bit, is mature industry, declining fuel volumes, but it's been very profitable the last few years, and multiples reflect that presently. And on a going forward basis, Tom, you see those multiples continuing to stay robust, at least for the next 12 to 18 months. So, our guys, a lot of you on the call here today are looking to be acquirers, not so much the one who is divesting of assets. And we wanted to have Greg come on and talk about some of the tips and tricks to consider going through the due diligence process. And so, Greg, I just turned controls over to you, so hopefully we can begin seeing your screen. But tell us a little bit about what we need to keep in mind as we go out to do a deal to make sure we are protected and ultimately getting the deal that we want at the end of the day.
Absolutely, that was a good segue, and Tom, very informative information. And Jed, thanks for having me here today. I think Tom kind of set the stage for my presentation here, which is maybe more focused and pointed on one area, which is primarily the insurance area. And so we're going to focus on synergies because although our firm has been around for 60 years, we created this, it's actually called the Private Equity and Corporate Acquisition Group. Created this about 11 or 12 years ago due to the high influx of deal flow that we were working on, trying to support all of our clients, whether they were corporate buyers or the private equity community. So again, my focus will be primarily on insurance due diligence and why we do it. So So I put this little org chart together because most of our clients have always historically had audit advisors, tax advisors, legal advisors. Our clients now have a sector graph in here for their insurance advisor, which in our case is us. The real reason these guys do this is one big value proposition is, the amount of deal flow that we do. So, I'll get into more details here shortly, but we've worked on about 200 deals this year on the insurance due diligence side, and it's more than just looking at P&L statements. It's a very in-depth process where we end up creating a report that's anywhere from 50 to 150 pages long, depending on the size of the deal and what we're asked to look at. So we have a lot of experience in many different segments. So what exactly are we looking at? So we're doing everything from property and casualty, employee benefits, executive and fund solutions. We have industry expertise, so all of our groups around the country are industry tied. We have transactional solutions and products to help get deals through and done. And then we support that with actuarial management. I'm going to spend the most of my time here due to time. I want to make sure I pay attention to that for everybody. Most of my time is going to be spent here in regards to what's our process. Why do large middle market companies do this? I can pretty much tell you that any Fortune 500 for sure, if not every Fortune 1000, will use some kind of a outside due diligence service to help support their internal risk management folks. They do that because the outside advisors are seeing deals, whether they're manufacturing deals or convenience store deals or propane deals. It doesn't really matter. We're dealing with property and casualty, employee benefits, 401k issues, and there's a myriad of things that cross over into all segments. So what exactly is it? Well, we create these PCAP reports, which PCAP just stands for Private Equity Corporate Acquisition Group. The main purpose of this report is to do a full deep dive insurance employee benefit due diligence to identify any of the major issues that are going to affect the purchase price. So our clients are engaging us at the LOI stage prior to the APA PSA stage. So there's that due diligence period in there where historically they're outsourcing that to us to help us identify drivers to create what Tom had been talking about in his presentation, synergies. Because we're doing these acquisitions and we're trying to capture synergies. We're not looking for the status quo. We're looking for ways to increase profit margins. So what's the first thing that we're doing? First thing on this first bullet here is we're identifying the current insurance and employee benefit expense. And let me stress, this is not just looking at a profit and loss statement. This is an extremely in-depth process where we're trying to understand the current expense, everything from what's happening under a self-insured retention, what's happening under a deductible, How are they managing and paying claims, whether it's employee benefits, whether it's property and casualty, it doesn't really matter. Every single target company has a different way of managing those claims. And frankly, some companies know 2 years out they're about to sell their company, so they change their habits to help promote cash flow. So our job is to go in there and really dig in and find out where the money is moving on all lines of insurance. Switching over to the other column, I'll talk here about the historical. So the bullet there is evaluating the company's historical insurance program for deficiencies. You guys probably already have the answer to this, but why do we do it? We do it, number one driver, it tells the story. We have more clients that walk away from deals once we do these first two bullets. And frankly, we have more guys that decide they want to go through with a deal after we help really truly identify the risk profile of that target company over a period of time. It doesn't really matter if it's a stock purchase or an asset purchase. Whether you're taking employees on, a lot of people get caught up in the idea that, well, I'm not acquiring any of those liabilities. Well, if they have trends and habits over the course of the last 5 years, those are going to be likely trends, whether it's loss driver trends, whether it's, you're buying a company that's got operations in multiple states, whether they've got, trucks, whether they've got gas stations. We're going to help identify the drivers of where the business is performing well and where it's not performing well from a risk standpoint. If there are any questions, again, just feel free to chime in. I'm happy to answer them. I know we're running on time here. So once I've got a current estimate of the full total cost of risk of all insurance, and I have the historical trends, which helps drive the program and give me color into what's happening, how this company is performing and why, I'm then able to actuarially predict what the future might look like. And that future that's a whole section of the report that could be 20 pages long on how we want to slice and dice this. Some people just, before they usually engage an outside advisor, whether it's us or somebody else, it doesn't matter. Sometimes it's just, I want to just get the deal done. I'm going to roll the assets in. Maybe it's not a stock purchase, it's an asset purchase. I just want to roll these guys in and get this thing done. The problem that we see in that is if you don't address the issue today in a full-blown, actuarial underwriting, submission format, then you're really just prolonging what happens so many times when you come due for your renewal and all of a sudden your underwriter's like, we just don't like this risk anymore. Because you've completely changed the profile, the size. You didn't take into consideration how the losses of the target company are going to affect the losses of your company. You have behavioral issues you have to deal with. One sector of the state's not performing as well. I mean, underwriters are just, they can be mathematicians. They're just crazy people. They have their reasons. So what we typically like to do is address all these things up front. If you can rewrite the entire program, if it's a decent sized acquisition, then sometimes the suggestion is to rewrite it. And the portability issues are important because all plans either are or are not portable. Again, this is all insurance. I'm not just speaking just to one. Sometimes the target company might have a richer or better, or for whatever reason, you would love to have their dental program or maybe their property program. Well, so having a cafeteria approach where the plan is or is not portable is important to know, because then you can scrap your program and take their program. So these are some of the things that we would be looking at when we're giving advice to our clients. Those are the three really big bullet points that make up the majority of the report. It promotes the greatest conversation on how to do a new structure or some kind of a cafeteria approach going forward. The other thing that we do is we identify contracts. So these are insurance or non-insurance contracts. We have attorneys on staff. That's all they do all day long is look for change of control provisions. So we're going to advise on that and how that might affect you in the deal. The next thing we're going to do is we're going to look at any balance sheet accruals. So in your guys' world, environmental is obviously a major thing. Whether you're retaining liabilities or not retaining liabilities, there's exposure there. So we help to identify that back to a period in time. It could be infinite because there's obviously been a lot of different, likely, especially in the C-store space, there's plenty of people that have exchanged portfolios over the years. So knowing that's out there, you can help write some stronger language internally in your PSA agreement. Switching over to the other column now, really the last thing I want to talk about here is I'm going to skip collateral is really an issue when you're a very large company. And so we identify any collateral issues that might be out there. But the last one is a real deep dive into the acquisition history. Again, this goes with understanding the history. It tells a story. We want to know how they've done this. We want to know what liabilities have been assumed. We want to be able to review any indemnity agreements. Are those indemnity agreements going to survive? Are they not going to survive? And how do we box that? And is insurance one way of boxing it? Sometimes it is, sometimes it's not. Lastly, but definitely not least,
Greg,
is the
quick
purchase
question here.
Please.
Yeah, so this is real important to do before you do a deal to make sure what you're buying is what you think you're buying. What if I'm thinking of selling? Does it make sense to do this type of review to show your own weaknesses that need to be addressed before you go to market?
Yeah, so the majority of our work is on the buy side for sure, especially once the LOI has been signed and then prior to the PSA. But yes, we do have clients that will come to us as a health barometer check, and they also sometimes want to pre-negotiate insurance policies that they can include in the sale of their company. We do that. That might be, if I had to throw a number out, it's not a lot. We might be 2 or 3 deals like that a year. But yes, if we develop, inefficiencies in an organization, well, one, if you do it far enough out, you can see what is not right in your organization, and you can figure out early on how to fix it. Maybe you do that 2 or 3 years before you actually sell the company. We've done that. But purely from a transactional standpoint, people will come to us and say, look, I'm going to sell the company in a year. I need to button some things up. So we can pre-write protective insurance policies that the next slide, we'll talk about some policies that are in place that people can purchase. So hopefully that answers your question.
Yeah.
Yep. So the last thing is, because we have attorneys on staff that are insurance-specific attorneys, all we do all day long is deal with claims, what claims are being paid, how to rewrite contracts. We're constantly negotiating with underwriters, changing language, helping the buyer along in the purchase and sale agreement phase is, in our view and our client's view, absolutely critical, because we help to stop some of these unexpected obstacles. So we will give guidance to your advisors on particular insurance language that might be important to use or contemplate or consider in the event that something does go south. How do we make sure, if you are going to buy insurance, it gets picked up? So that's where our attorneys come into play, and that's where the PSA becomes important. This last page, I'm just going to focus on 3, is once the report is issued, however big the report might be, once the presentation's been made, the buyer knows everything that is in their way prior to signing their deal. They may decide that we want to do some reps and warranties insurance, which really is the #1 driver in the industry today. So normally on the larger deal, and I would say to do a rep and warranty policy, you got to be looking at about a $25 million deal or north of that. These are insurance policies that are there to protect the reps and warranties both from the buy side or the sell side. It doesn't really matter who picks it up. It could be a shared expense. But again, it's there to really close these challenging deals. And if a rep or warranty is breached, you've got insurance as a backstop. The one I actually like the most, because I just got done dealing with one with a buyer client, is contingent liability insurance. This is the one where if you really want a company bad, but it's got a real headache out there, maybe like a pending lawsuit, and you can't really put a box around that lawsuit, yet the seller is willing to give all sorts of indemnifications, but you're just not getting your hands around it. Most guys walk away. But every once in a while, you'll get a buyer that says, hey, I want to push through. So what you can do is you can buy a contingent liability insurance policy that'll put a box around that lawsuit, subject to, potentially pretty large SIR or deductibles, but you can put a box around it. So if it's $1 million liability, and it breaches that and it goes to 5, at least you'd have an insurance policy that potentially wouldn't blow up the deal. They do tax ones, but I'm going to skip that. The main one everyone on this call is likely familiar with is the environmental liability policy. So the basics behind this is that you can buy an insurance policy that will go back to an indefinite amount of time in the gas station space or the bulk plant space, whenever this plant's been around, that will insure around everything that is not a marked and known contaminated condition currently. You could have contaminations from the 40s as long as they've been closed out. You can buy insurance to protect that. So these are your sleep insurance products where you're buying them because you're really wanting to close this deal, and you've got all sorts of indemnifications that are going back and forth. You possibly have had 2 or 3 buyers and sellers on this property over the course of time. You have no idea if these indemnity agreements are going to withstand time, if there's even money to pay it out. So if you don't want to deal with that, you don't want to do a phase 2, you do your phase 1s, you buy your insurance policy, and you close the deal. So for the sake of time, I'm going to stop there. Jed, I don't know if you have any questions specific to that or if you want me to bounce back. I tried to run through that as quick as I could, but
yeah, I think that gives us a good high level of some of the options that are available to us. I think how you described it well, if we get to a point where we're stuck trying to negotiate on a deal, there may be an insurance option available that can help us overcome that bottleneck.
Yeah, and the insurance is always the end result for us. It's the process. It's that stage between the LOI and the PSA, which is where all the value is. And I would say, all of our clients that utilize this service, it's just ingrained in their structure now, so that their team can go about doing other things that their team needs to do. Most companies, except for the very, very large clients of ours, the Fortune 250s, they've got some people on staff that are very complementary to what it is that we do, and they do drive maybe 70% of the process. What they don't have is the market knowledge. What they don't have is what's being paid in the industry from a claim standpoint. They don't have what other companies are doing and how they're dealing with acquisitions. And so that's where having this, some kind of an outside advisor that knows the market, knows deal flow, really pays some nice dividends for buyers. If nothing else, it makes them aware of what they're getting.
Makes sense. Well, Greg, I just want to say thank you for that high-level overview. Greg's willing to make these slides available as well, and I will send those out to everybody probably in the next day or so. And also, there'll be a link if you want to share this rebroadcast with anybody in your organization or friends that you know. But Tom, Greg, really appreciate your time and for you being on the call as well. I hope you found it to be informative. Hope you have a good day. Goodbye.
Thank you. Thank you very much.